Hello, and welcome to the Logistics Management Podcast Series. My name is Jeff Berman. I'm Group News Editor for Logistics Management Magazine and also the Peerless Media Supply Chain Group. Today, it's a real pleasure to welcome back Chris Rogers to our podcast. Chris serves as Head of Supply Chain Research for S&P Global Market Intelligence. Chris has more than 10 years of experience in building research businesses covering corporate decision-making and government policy in the supply chain and logistics sectors at S&P Global, as well as previous posts at Bloomberg and Flexport. Chris's prior experience also includes power, gas, and emissions market and analysis at investment banks, including JP Morgan and UBS. Chris, welcome back.
It's great to be back, Jeff.
Absolutely. So why don't we just jump right in, Chris? A lot to chew on here. We just saw your data for Q1, which we published in Logistics Management. Let's take a look back at the first quarter. And in terms of U.S. bound imports and shipments, you can also touch on March as well. What was sort of happening there? What are the trend lines telling us?
Yeah, so I think it was a real big start to the year, a stellar start, as we called it in the research, with imports to the US up by 15% in terms of containerized freight, including 16% in March. So this wasn't just a one-off boom month; it was a pretty strong quarter altogether, and that strength was pretty widespread. So when we look across the piece, there was 20% growth in materials, so stuff like chemicals and metals. There was 15% growth in consumer discretionary goods, so that's everything from auto parts to home furnishings and appliances. And there were some other areas that grew a little bit slower. Consumer staples, so stuff like food, healthcare products, they grew by more like 8%, so a little bit slower. Capital goods was a little bit slower as well, grew by around 12%. But generally speaking, it was a pretty strong start to the year compared to last year.
Okay, that's great. That's great to hear. And as the year moves on, it's never too early. I guess we're right on time. Actually, it's May 1st here. It's peak season, always close to top of mind, if not top of mind. And with that as a backdrop, how are you approaching this year's 2024 peak season? What could be in store? What are some things to monitor or look out for?
Yeah. So I would say first thing is we don't expect the kind of boom that we had in the first quarter to continue through the rest of the year. The first quarter of 2023 was somewhat exceptional because we'd had a rapid period of destocking of inventory reduction. We can talk a bit about why later on.
Yeah.
So effectively, you're comparing, a regular first quarter this year to a pretty skinny one last year. So we actually expect growth to slow somewhat during the year. So what that means as we go into peak season is that the kind of baseline for underlying demand should be a relatively normal year, whatever normal means. I mean, you and I have been talking together for years and years, and it never feels like a normal year. So going into peak season, normal assumption of normal baseline. However, there's been so many different things that have affected the logistics networks over the past 6 months or so that, when we speak to our customers, when we look at the data, it's clear that people are thinking maybe about shipping a little bit early this year. If nothing else, you've got to start shipping a little bit earlier than normal, because if you're shipping into the US East Coast, stuff's just going to take longer to get there. If you're coming if you were going to be going via the Suez Canal, you've got to go around the Cape of Good Hope. That's an extra 2 weeks. The Panama Canal is doing better, but still isn't fully reopened. So, you need to leave a little bit of space open for that. We'd also see this year the potential for a second peak season much later in the year, depending on the outcome of the US elections. A desire to avoid that might be another reason to start shipping early. But there's a lot more to talk about before we get to that.
Yeah, absolutely. And I do want to touch upon inventories just in a moment, Chris, but you had talked about what you said something like, what is a normal peak now? But it is nice to see sort of more of a regular cadence or tempo, if you will, especially compared to 20 2020 and 2021, when there was everything was obviously wildly shifted by the pandemic, and there was sort of a peak season all the time vibe there for a while. So is it nice to see things, regardless of what we're seeing in terms of the numbers, have a more typical rhythm?
Yeah, absolutely. I think, as we've talked about before, 2020, 21, 22 were exceptional, if nothing else, for the fact that it was a very demand-led boom that we saw. So the congestion that was occurring wasn't because the ports were shut, it's because we were just trying to jam too much through the pipeline,
Yeah.
which is why when we talk about, consumer spending being somewhat normalized, manufacturing spending being normalized, and actually, if anything, just coming off a low. If you look at the S&P Global Purchasing Manager Index, there's very much more sense of normal underlying demand, which means the shipping companies should be able to deliver if the seasonal pattern itself remains following that usual. Stuff starts to leave China in bulk in July, start arriving into the US in kind of August, September time.
Okay, terrific. So, one of our tried and true topics of conversation, Chris, always centers around inventories. There often could be a disconnect in how people approach what's happening. Imports remain solid. Uh, Inventories are in a drawdown period, an ongoing drawdown period, so it seems. How do we reconcile all that? How would you assess the current landscape as it relates to inventories?
Yeah, so I think there's plenty of reasons to think inventories are still coming down. So if we look at the S&P Global PMI for manufactured finished goods, in most sectors that's still falling month over month. That's a survey we do every month for around 27,000 firms globally. So
Okay.
that would suggest that inventories are coming down. Second, if we look at the financial data, if we look at the data coming out of S&P Capital IQ, we can bring together that all big American businesses that have inventory management, their inventory to sales ratio. So how much are you keeping on hand to meet demand? And that inventory to sales ratio really across the piece is coming down to the level it was at before the pandemic. So in 2016 to 2019 period. And the big reason for all of that is interest rates, right? If you want to keep inventory, if you want to keep, it's like keeping cash on the shelf, and cash is expensive at the moment. So it's perhaps not a surprise that companies are cutting back because of interest rates. The other part of it, and we hear this a lot when we speak to our customers, is look, we learned that we need to have a just in case approach for our most critical items. But actually, for everything else, we found that running low or even running out isn't the end of the world. So we're seeing a more nuanced approach to inventory management from a lot of firms now than maybe we did in the past. But all of that still adds up to the fact that inventories to a certain extent are coming down. And I'd note as well that some of the warehouse rates are coming down now as well, which would suggest that net inventory is still on the decline. How do you reconcile that to accelerating imports? The answer is consumer spending and manufacturing spending is still strong. I mean, it's not wildly strong, but it's not falling as I think maybe some of the more bearish outlooks suggested that it might.
Sure, sure. And not long ago, a little more than a month ago, we all saw the tragic collapse of the Francis Scott Key Bridge in Baltimore. Obviously, that had a impact and still does have an impact on freight flows, specifically along the east and Gulf Coast, with freight that was destined for Baltimore, obviously being rerouted to other close by ports. How do you see that situation now, a month later? In terms of throughput, as the port has opened a temporary channel. What's the impact been like? What have you seen from the data and from your customers?
Yeah, so I think the first point is that this is another example of just how well the logistics industry deals with the unexpected. The US Army Corps of Engineers have, really stepped up and have started, as you say, reopening these smaller channels, should be close to moving the Dali in the next few weeks. By I think May 10, they were wanting to get it moved.
Hmm.
And our numbers show pretty clearly that all the major liners that were serving Baltimore could quite easily divert to the other ports in the area. And the fortunate thing in what was fundamentally a human tragedy, the fortunate thing was it happened during the off-peak season. So there was spare capacity at the other ports. You weren't seeing vessels arriving, horribly overloaded and not having options. Clearly, some of the liners chose to declare force majeure, and that's been a problem for some of the cargo owners and for some of the forwarders. So it's not been without its bumps. Where we have seen more of an impact has been in terms of shipping vehicles and heavy equipment. One of the things we noticed in our data is diversions to Providence, which kind of surprised us. That wasn't one way we were expecting to see a lot of diversions there. But again, it shows the inherent flexibility in logistics networks. With any luck, this will all be cleared through in time for peak season.
Okay, got it. And just real quick, Chris, for our listeners that maybe aren't familiar with the term force majeure, could you just quickly tell them what that means and is?
Yeah, sorry, of course. So within a contract, you will have a clause that says if certain things happen, and here we're talking kind of act of God type stuff, I have the right to break the contract and basically leave you to it. In the case
Right.
of containers, what will sometimes happen is the shipping company will go, well, we can't deliver it to, Baltimore, so we're going to drop it off in Norfolk, and it's up to you as the cargo owner to get it to where you need to get it to.
Okay. Okay. Understood. Um, and let's shift gears to the Far East and talk about China for a few moments, Chris. Obviously, the U.S.-China relationship is and remains tense, I guess, to use one word. Um, but so how do we kind of and part two of that, there's this difficult relationship. We still obviously count on China so much for so many of our products slash imports. And there's also the rise of nearshoring in Mexico. We're seeing it with a lot of different logistics services providers and also shippers setting up shop, whether it's in Texas or Monterey, and operating with these maquiladoras to get manufacturing operations going. Why don't we take it in two buckets? Why don't we talk about China first, and then we can shift gears to the U.S. Mexico dynamic, the nearshoring dynamic.
Yeah, sure. So I think when it comes to China, there's two main elements to bear in mind at the moment. The first is that there's been a real acceleration in exports from China, which has partly been due to a slowdown in demand for a lot of domestic goods there, and partly due to planned export growth expansion really now coming to fruition. It's been no secret that Chinese companies have been building up their capacity in electric vehicles, in batteries, in a whole bunch of other manufactured goods, even in things like basic semiconductors. So the fact that all of those goods are starting to land in the US and the EU, shouldn't be a surprise. And that's one of the reasons why we've seen a pickup in exports from China. We've also seen, again, as I mentioned earlier, a pickup in imports of all types because last year was so weak, and that
Sure.
kind of went double for China as well. So I think that was a big element of it. So that's one part. The second part, which is related to that, are these kind of long-term geopolitical tensions that, to a certain extent, are driven by kind of the natural rivalry that you would see between great powers. I think what's different here is that you've got kind of US rivalry with China, and you've also got EU rivalry with China, and they're being played out in different spheres. In the case of Europe, it's being played out very much in the manufacturing sphere, specifically around manufacturing of electric vehicles, renewable energy goods, and so on. Whereas in the US, it's being played out more in the national security sphere, particularly around high tech, so semiconductors, semiconductor manufacturing equipment, and the related software areas. And no matter who wins the election in November, those tensions are going to continue. All that will change is how are they being played out? Will they be played out in the form of tariffs, or will they be played out in the form of a more diverse set of national security options?
Okay. And let's move over to Mexico. Obviously, the earlier in the year, the news that the data showing that they are now the top United States trading partner.
Yeah.
I don't know if it caught everyone by surprise. I mean, I think it's probably been trending that way, but when you see them at the top of the list, it was like kind of like an oh my goodness type of thing. It's happened. So how would you assess the current state of things as it relates to cross-border logistics slash nearshoring?
Yeah, so I would say, first, Mexico's ascent has taken many years. The tariffs that were applied by the Trump administration back in 2018 were part of the driver for that. So, roughly speaking, China's share of US imports of the goods hit by tariffs fell from 18% to 11%. About a third of that gap, if you like, was filled by Mexico. Another third was filled by Vietnam, and the rest was filled by other ASEAN countries and other countries around the world. Um, where Mexico filled in was very much around capital goods and autos, whereas Vietnam filled in more in terms of electronics. So each side very much playing to their kind of inherent manufacturing strengths. So Mexico definitely benefited from that. The reformation of the USMCA trade deal also meant that there were very specific rules about what could be imported free of tariffs from Mexico. So that kind of encouraged more location there as well. So Mexico's done very well out of it from a kind of political and regulatory perspective. The challenge at this stage is the logistics between the US and Mexico are not always smooth. We've got inspections to trucking to deal with,
Hmm.
protests on the railroads, potentially strikes on the railroads, and strikes in the ports as well. So, this concept of being near somewhere is useful, but it's certainly not the whole story. Otherwise, no one would have gone to Vietnam. They'd all have gone to Mexico. The next challenge for Mexico really is, as we go through the next 3 or 4 years, is to maintain that momentum to continue to attract new business in. One of the ways they're doing that is to make sure that they don't become a dumping ground for products that will eventually end up in the United States. And we've seen just recently the Mexican government have applied new tariffs on 500 products designed to do just that. The last thing they want to do is get the other side of the next elections and find that the USMCA trade deal is being reviewed again because there's too much stuff coming from China, for
Okay.
example.
Right, makes sense. And just to wrap up, Chris, let's talk about the full year
Mm.
2024 outlook. In recent data that you had sent over to us, and I just want to go through the numbers real quick. This is talking about US bound shipments. You have the second quarter pegged at 7% growth, annual growth that is, third
Yeah.
quarter at 4%, fourth quarter at 3%. So you see kind of a trickling down in the growth rate as the year goes on. Um, what are the key factors or drivers comprising those estimates?
Yeah, so I think a big thing is, without saying the same thing repeatedly, the first quarter of last year was really weak. So the first quarter of this year looks really strong, but the
Yeah.
back end of 2023 was more normalized. So you're then comparing a normalized 2024 to a normalized 2023. I think areas where we see the growth kind of decelerating quickest amongst some of the industrial components, so chemicals and metals. Also, on the other side, starting to see a bit of a recovery in particularly in apparel, which has been notably weak. So kind of a rebalancing. Again, who knows what normal looks like? But the idea is that over the longer term, trade doesn't tend to grow that quickly, and we're kind of approaching as we go into 2025 a more normalized state of affairs.
Right. Understood. All right, look, Chris, that brings us to the end of our allotted time for today's podcast recording. So, on behalf of Logistics Management Magazine and also the Peerless Media Supply Chain Group, I just want to offer up a huge thanks for joining us once again. If the numbers are telling me correctly, I think this is the fourth time we've had you on for a podcast. So, welcome back.
But always a pleasure, and look forward to being back again.
Yeah, absolutely. And for those of you in the audience, Chris is on LinkedIn, so please feel free to go ahead if you want to connect with him there. It's just linkedin.com/IN/CH Rogers /. And for those of you on Twitter, please feel free to go ahead and give us a follow, simply at Logistics MGMT. And also, if you're not already subscribing to our podcast, please go ahead and do so wherever you get your podcasts. Just go ahead and look for Supply Chain 24/7 and it will pop right up. Thanks, everybody. Have a great day, and we'll see you next time.